Welcome to New York, where we've just come off a very busy earnings season for the big banks, and I'm joined by Tom Braithwaite, the US banking editor. So Tom, what kind of week has it been for the big investment banks like Goldman Sachs and JP Morgan and so on?
I think if you're a Goldman, you're feeling pretty happy, and they seem like they've enjoyed themselves after the first quarter. Their return on equity of 14.7% is the best in 18 quarters. It's the best investment banking result in about 4 years. They've got a big tailwind from the M&A market. Trading's doing better, and they're paying themselves smaller bonuses, which helps the bottom line as well. Staying
with Goldman, you said that costs have come down, remuneration has come down. That's what the regulator wants to see, right?
Yeah, and I think that's what shareholders want to see. I don't think the US regulators are massively prescriptive here, although they'll also welcome it. But I think Goldman has made the decision that even though times are looking a bit better, they're not going to pocket that wealth themselves. So look, bankers are still well paid. 42% of revenues for the first quarter being set aside for bonuses at Goldman, but that is lower than last year, lower ever in fact for a first quarter since the bank went public in 1999. So it's a sign of intent, I think. If you're a trader or banker at Goldman, you're not expecting a staggeringly massive bonus at year end right now.
And a lot of these good results in the first quarter were caused by volatility, particularly in the Swiss franc, where lots of people made money, some lost money on that turmoil. What are the prospects of that continuing into the second, third, fourth quarter?
Yeah, I think Citi lost money, as a couple of European banks lost money on the Swiss franc spike, but others managed to navigate it a little better. Yeah, volatility for the second quarter, I don't know. I mean, all the bankers I've spoken to seem to think that trading's a little softer in the first couple of weeks, but not disastrous. So I think it's been a decent start to the year. We'll see if that continues next week with Morgan Stanley's results. And obviously we've still got big European trading banks like Deutsche to report in the coming weeks. But I wanted to ask you a little more about some of the Main Street operations of Citigroup, B of A, and all the other US banks, where life seems a little less exciting right now.
Yeah, this is a very, well, the picture is inconsistent between Wall Street, where things are beginning to recover after the past 5 or 6 years of pretty miserable conditions, and Main Street, where I think the consumer is feeling pretty strong, but the banks themselves are not experiencing the benefit. And the main reason for that is the net interest margins, the difference between what banks pay for their funding and what they earn on their assets. And that has been shrinking ever since the crisis, and it's now, I think, at Wells Fargo beneath 3% for the first time in decades. And until the Fed actually pulls the trigger and raises the short-term cost of funds, I think the outlook there is very bad for the banks, or at least very static. So, and they're running out of levers to pull to offset that shrinking net interest margin. Costs can come down, of course, and Citi is one of the most active banks in that respect, busily exiting markets all across America. Chase is also optimizing its branch network, Bank of America also. But there's only so far you can go with that. I think US Bank Corp this week, interestingly, was talking about the limits of that kind of headcount reduction. It wants to preserve service, which when interest rates come back and when demand comes back, then you can respond.
And I mean, people have been pretty patient, but the interest rate rises have now been expected for what, 3 years? So are they still, CEOs still talking about this as just around the corner?
No. The overwhelming feeling I got from listening to chief execs at Wells Fargo and Citi and Bank of America this year was that I think in previous quarters they have made statements to the effect that yes, when things come back, we're ready. But now there's more of a sense of fatalism, I think, as these expectations within the market get steadily pushed back. I mean, we were talking about June for a rate rise a few months ago. Then it was September. Now people are thinking maybe not until 2016. So the tone of those comments has definitely softened.
Is it feeling a bit like Japan, where you've just left?
What, permanently rock bottom rates and sluggish demand for credit? I think, yeah, we are seeing some elements of the Japanization of the American banking system. I've just spent a few years in Japan, and the banks there are permanently used to this environment, and then they expect never say never, but they are budgeting, they're planning on the basis of ultra thin net interest margins. And I think American banks are beginning to come around to that.
So perhaps even though they've not been flavour of the month for 5 years, we're going to be looking to the investment banks to provide some growth and excitement for the next few years.